Good evening. Happy Ides of March to all of you who are not keeping score at home. It's uh, it's an appropriate day, I think, to talk about the uh, the various shenanigans going on in U.S. financial markets. And I have with me this evening uh, Joe Dolio, fraud examiner extraordinaire, who's been rushed into service on behalf of the FDIC. He's going to be departing for a bank to be named later at some point. Track down shenanigans that are going on with actually though what you'll see though with these banks that we're going to talk about this evening, the shenanigans occurred in broad daylight. There was
Mhm.
no attempt to really do much of anything to hide the silliness that was going on in most of them, with the exception of Credit Suisse.
And they really
And
weren't complicated schemes or anything either. It was just
no, actually,
silliness.
they were just endorsed new cultural norms to a great
Yeah.
extent. So, and we have, we're fortunate that we don't have smell vision because we have day old sushi with us today, otherwise known as Old Hong Kong. Jim, how are you doing this afternoon or this evening?
It's good. Busy
The-
day out there in the world.
Yeah, you always buy your sushi a day old. It is cheaper that way.
No, I don't buy it. I just make it.
Oh, okay. All right. And Colonel Mike Bennett reporting in.
Yes, sir. Howdy,
I-
Kevin Oliver. In the chat.
Oh, I
Yeah.
see. I thought maybe we had a brain freeze or something
I
going
know
on.
that dude.
And Watcher's got big news this evening. I don't think he wants to announce it now, but stay tuned for news at some point with respect to Watcher's developments on the Ides of March, which shows no small level of courage
Yeah, right.
to do what he's done today. So
Thanks.
we were about to die. Salute you. So,
Damn the torpedoes, full speed ahead. All right.
all right. So let's get underway because I do want to save time for viewer calls, comments, what have you. We're going to work without a net here a little bit.
Do you want me to give the instruction real quick on?
Yeah, if you just flip to the next slide, you can walk people through how to do
Okay.
it. Moving on.
Fantastic. So
So-
basically, all you need to do is join the Gilded chat. I'm going to pop Gilded up here real quick, and I will send you a link in the chat on both locals, or sorry, on everywhere that we're currently live, so that you guys can join in if you want to. You're going to enter the new channel that's been created called the Privy Council Waiting Room. When you get in there, you're going to type out here, and that is going to essentially be your indicated waiting space in line if more than one person is trying to get in. I'm going to send you a DM and kind of pre-screen you. If you pass the screening, then I will send you a link to join the call, and then we'll shuffle you through when your time has ended.
And I'll ask that that we all observe some level of decorum in this instance, because Watcher will have a hook, but it's not. I'll be bluntly and brutally honest with you. We're not running a 7-second delay, so let's be mindful of that. And we welcome you and your comments and questions at a little bit later point in the show. What I thought we'd do is sort of take us through a high level look at sort of, talking heads is always great. You may ask yourself, how did I get here? We used it last week. We're using it again this week. And so we're going to walk through sort of an overview of the events. I'm assuming if you're here, you've been paying some level of attention to what's gone on in financial markets and banks and some of the other aspects. We're going to try to keep this concise. We could spend 2 or 3 hours looking at silly videos posted by the management teams of some of these institutions. We're not going to do that because we think you guys have probably already seen them, or you can find them by just Googling silly videos by Signature Bank as an example, in which case you'll see Signature Bank employees dancing with chicken feathers on, and a diversity, equity, inclusion seminar unfolding behind them. I don't want to propagate that. It is funny. You should watch it at some point, but we won't do it here because we want to save time for your calls. So with that, I want to talk a little bit because this is important to me as an older gentleman. I want to talk a little bit about how I think we really did get here, and I think that our financial system, our country, has been sort of addicted to low interest rates really since 2000. In the wake of the dot-com bubble, and many of you may remember that was sort of the first iteration of the financial crisis in which businesses that weren't quite ready for prime time were able to achieve unheard of valuations, measured on metrics like how many clicks or eyeballs they were generating, and it all ended in tears. We took a little while to get out of it. We had very low interest rates and credit and money for nothing and chicks for free, which metastasized into the housing market and brought us the great financial crisis, which brought us not just low interest rates again, but also taxpayer capital bailing out the institutions that created the problems to begin with. And so what investors in the U.S. stock market have learned is that there's almost no downside to being exposed in the marketplace, because if we get into trouble, the collective the Fed's going to be there to bail you out. Not just people in banks, not just people in other institutions, but the market in general. And so we've raised a whole generation of people who know nothing but they listen to Jim Cramer and say, we're going to buy the dip, buy the dip, buy the dip, because Uncle Fed is never going to let us down. And I think what we've seen in the last year with the rise in interest rates, and by the way, tomorrow is the first anniversary of the first rate increase by this Fed to try to cure transitory inflation. And we've done it at, as somebody has in the chat, ramming speed. We've done it at ramming speed, and that has brought home the fact to investors that that there is a cost to money, and you have to think about things in a different way, and that there are long and variable lags to federal action, Federal Reserve action, and we're starting to see now those actions pose problems. We've got some stuff that's starting to break. Now, I'm going to walk you through why I don't think it is 2008 all over again, because these are very different sorts of issues, and they're not as systemic as they were in 2008 through 2011, if you will. Anything that we talk about today, I do want to give you this disclosure. Hey, there's Ron. Let me finish up and we'll come back to Ron in just a second. None of this is investment or financial advice. This is a conversation for your broader enlightenment. I don't recommend that you take any actions on the basis of this. And you will get no BOOYAHS on the Privy Council. We're not going to borrow a page out of our favorite inverse commentator. Ron, welcome back. How are you?
I am well.
Good
Nice to be here.
Yeah, good to see you as well. So, anything you want to contribute to the good in the Commonwealth before we get started?
No, I'm hoping to earn 3 hours college credit of some sort of financial advice and things like that.
Yeah, I don't know that you'll quite get that, but it should be an interesting conversation. But so let's move on. And let's talk about this next slide. And I think I want to talk first about Silvergate Bank. Silvergate Bank is a little different than some of these other banks. It was the first to go into receivership or into liquidation. It was almost a pure crypto play, and to a great extent is a direct descendant of aspects of FTX, because they ended up with a lot of customer assets basically in FTX at the time that Sam Bankman-Fried decided to pull the pin on the hand grenade that is FTX. I don't think we need to talk about who FTX is, what it was, how it's unfolded. I think most people understand that. There's billions of dollars of people's money who is missing, and they're trying to find it, and They may find some of it. They may not find some of it. This bankruptcy is going to go on for a long, long time. And I'm hoping that Sam Bankman-Fried doesn't see fresh air for a while, and I suspect he won't. It is something that I think certain folks would like to have it just go away. But I think if he was going to get Epstein, he'd have been Epstein by now. That's my opinion. So we'll see what happens. But so this bank really sort of started this recent round of sort of breakdown when it went into receivership. And I'm going to set it aside for purposes of what we're talking about today, because I don't want to turn this into a crypto discussion. I think crypto is symptomatic of what we've seen. It's an asset class, much like the dot-coms, that sort of got inflated beyond its true value, to the extent that there is a true value. And I think it's just, it's the tide went out and we're seeing who doesn't have a bathing suit on, as Warren Buffett likes to say. And so it's a standalone sort of situation. It's tied up with this, but it all of the crypto stuff isn't enough to generate sort of the angst that we're seeing in financial markets. So I don't want to focus on this per se. So let's move on if we could. Now, here's where we transition from crypto player to old bank on the make, I guess is the way I would describe this. Signature Bank is an old line traditional bank in New York State, and decided in the not too distant future that it wanted to be a big player in crypto lending. And where these banks get in trouble is lending against crypto. Even the Winklevi, the twins who were Zuckerberg's buddy in the founding of Facebook, got into crypto lending, and their company is now in bankruptcy as well. But these guys, they had a little bit of SVB and a little bit of Silvergate all sort of mixed together in what had been a venerable private bank with a pretty good private bank wealth management arm. But they got out over their skis. They sort of lost their focus. As I said, this is the one where you can see the dancing chicken feather employees in a video that they thought was a commercial. And so this bank has also been taken down, I think largely about crypto, but the state of New York doesn't want to call it that. So they've said it really wasn't ahead of it. Really, crypto had nothing to do with it. You'll see that bullet point there. That's the Department of Financial Supervision saying that in the state of New York, because it's a little bit of egg on their face if they let that happen. But this is a bank where they were already under criminal investigation at the time that this stuff started to break out on a wide variety of topics. And I'll pause here for just a minute because I want to point out we've seen elements of the Democratic Party try to lay all this at the foot of Donald Trump, and some easing of Dodd-Frank regulations in 2018 that was wildly supported on a bipartisan basis. But I think the really sort of interesting aspect to keep in mind as it relates to Signature Bank is that Barney Frank, the co-sponsor of Dodd-Frank, has been a board member at Signature Bank for a long, long time. And
Stan,
yeah.
Do you mind if I add an exuberant harumph right now?
Please do. That's
okay,
why I think that's why you're here. Okay.
I am here to harumph, just to
All
let
right.
everyone know.
All right. Now, would you like to expand on that harumph?
No, I'm not really qualified.
Are you harumphing in agreement or in objection?
That is up to the listener to discern.
Okay.
I like to leave my harumphs ambiguous.
You want to leave a little wiggle room there.
Yeah.
You too could probably have been a board member here then, if that's your modality. But,
exactly.
I don't think Mike ever hopped off a little bird in P-Town. No, I can't see that. So not on this board.
Yeah, but I'm so here's the co-sponsor of Dodd-Frank, the widespread bank re-regulation on the heels of the great financial crisis, who's a board member, has access to everything that there is to have access to as it relates to this bank, including examination reports by the state of New York. And his comment the other day was, you can read it, "I'm surprised," Frank said in an interview, that was not my understanding of where we were. So I think a lot of this is the manifestation of that age-old human vice of hubris, and probably some other things which we can talk about a bit later when we get to Silicon Valley Bank. So let me stop. Panel, any other members of the council? Is there anything that you think we ought to talk about?
I do want to point out PD has added a little bit in the chat as to the reliability of Mr. Frank's.
Yeah, he's pretty obtuse, that Frank. He doesn't seem to be very noticeable. He's not very attentive to what goes on in his surroundings. A lot of things got done on his watch. That's for sure.
I like what Margot put in the Rumble chat over there. I don't know if you guys are watching that, but that's a good one. I had heard that story.
So Barney, because I'm not watching.
Barney, my boyfriend, ran a Twink Bordello, Frank. Yes.
Yeah. It's how these people are still out walking around breathing free air is a broader question for society. We won't try to tackle that today, but it is sort of remarkable, and we do sort of see the same faces in the same places over and over and over. All right, so let's move on. We'll try to tackle now Silicon Valley Bank. And I really do think that you could title, we could do a whole show on Silicon Valley Bank, and it really would be titled, well, what would happen if we did everything wrong? Because I think that this is a manifestation of a management team and a board that did everything wrong. And they did it in service of this vision of what future banking would look like based upon the values of Silicon Valley and a focus on providing banking services to very early stage companies, many of which are VC venture capital portfolio companies. And venture capital portfolio companies, if you're not aware, all have the same characteristic. They don't have enough money most of the time, or they have money only for a finite period of time in which they need to produce results that gets them more money from venture capitalists until they create enough value to go public. And that's a pretty risky, I mean, if you look at the really good venture capital companies with track record like Sequoia and some others that have been around for a long time, a typical 10 company portfolio, 4 of those are absolute write-offs, 3 of which are probably sort of middling returns, and 2 of them are rock stars. And that's sort of the dynamics of venture capital. There's a lot of broken glass, apropos of the slide. There's a lot of broken glass in venture investing by definition. And so for Silicon Valley to say, we're going to focus most of our banking services on servicing both venture capitalists and their portfolio companies is taking an outsized risk. It's like saying, well, if I'm going to make loans only on commercial office buildings in central business districts. That would have looked good at one point, but now it looks like a disaster. So they've taken one big risk shot out the gate, and then going further with that, they've populated this bank with basically Democrat donors and wokesters, and evidence of that is that their board did not have Barney Frank on it, but it did have 12 board members, only one of whom has banking experience, and he just joined the board. I think it was late last year. So it was, but they were the woke Crayola crayon 64 color. I mean, they checked all the boxes. There were all sorts of different varieties of human beings. I won't go through it, but nobody that knew much about banking, but a lot of them wrote checks to Democrats in the process of becoming board members of Silicon Valley Bank.
Well, for California, it wasn't that bad, Stan. I think it was only like 94%.
91% of the board.
91.
91% of the board. Now,
I swagged it, so I'm kind of close.
Yeah, you were close. You were within one standard deviation of that. And now I had personal experience with Silicon Valley Bank. I was involved in a biotech startup company that at the time that I got involved, was already banking at Silicon Valley Bank. And I'm not going to go through each aspect of it, but there were lending practices there that curled my hair, and things that were done on a routine basis that are way outside the standards of prudent lending in order to keep us there, keep us in the bank, keep our cash at the bank, and to sort of weld us. It's like the Borg, surrender and assimilate, weld us to their banking platform. And at the point where I could, we were gone. But it took us 6 months to get out because they just wouldn't return phone calls in terms of, releasing liens and other stuff, because they wanted us to stay. And I saw enough there to know that Silicon Valley Bank was looking for trouble from the get-go, and that was 2017 at the time. So it's been a while in coming. And again, what happens is that when interest rates go up and money actually has a cost, these things show up. I think the other thing that they did was they took in an enormous amount of money during COVID. From 2019 to 2021, their deposit base went from 60 billion to 180 billion. And they didn't know what to do with that much money. And they stuck it all into treasury bills and mortgage-backed securities, which is not a bad play. But the problem is they went very long in maturity. And banks, when they do that, have to mark those assets to market as to what they would be worth if they had to sell them today as part of their capital measurement. And when that happens, starting a year ago tomorrow, and rates rise, the value of fixed income instruments goes down as interest rates go up in order to achieve the same yield to maturity. Now, this is a little dry, but bear with me on this. So let's give you an example. So let's say I bought a treasury bill in 2020, and a 10-year treasury was 50 basis points, somewhere in there at some point during that time. And today the 10-year treasury is, let's round it off and call it 4%. Well, what do I have to do to mark down a treasury bill that I bought at under 1% in order for it to yield 4% to the new buyer? And that is, you have to take a discount. And so they just willy-nilly did this and then did nothing to change it as rates were going up. And this is what created a lot of confidence. That, and the fact that some of the venture capitalists who had been proponents of this bank, for reasons that I don't think we've learned yet and may never learn, decided to shoot this bank in the head. And that's our good friend Peter Thiel, who on Wednesday of last week basically tweeted out that he and Founders Fund and all their portfolio companies were getting out, and they thought you should too. At that point, Jim, anything you want to add to that?
Stan, I think it kind of sums it up. It was an old boys and girls club of Silicon Valley, and it was one of those things of if you're popular, you got access to all sorts of subsidized lending, and if you were on the outs, they all knew, and the struggle was on, and you had to reach out to other sources of capital beyond Silicon Valley's reach, and Silicon Valley's reach was broad.
I like to think of Silicon Valley as the woke Bohemian Grove, and if you know,
no, it's exactly it's like the Grove. It's like the Grove with a checkbook instead of the Grove with the relationship you had to nurture. The guys at the Grove are okay. I don't want to throw anything at them.
No, but it's sort of cult like, and so
well, yeah, but the clubs are like that, and men are like that, and that's a male intensive place.
But this is a place where everybody who wasn't a man, or wasn't planning to transition to be a man, or was a man who necessarily liked other men, could feel comfortable walking around in the redwoods naked. Is that right?
That's a bit of a reach, but no, not so terrible for everybody. But my take on Silicon Valley Bank is they built a really good franchise. They did a really good job on behalf of their clients. Where they really stumbled was it was a niche, not a big bank. And when they became a big bank and began to do private wealth, really large, very, very responsible activities other than throwing money that was other people's money at organizations and backstopping venture capitalists who were highly exposed to them. They created a kind of they created a trap for themselves because they really brought in people of like mind. And one of the recruiting traps is you hire people like you, and so it was a dragger rebreather on in a perfect sense. They never changed gas, so if you didn't fit culturally, they didn't bring you in, and they ended up with a monoculture risk problem, which was we have an extra couple $100 billion. Let's push it off into treasuries and we'll be fine. They weren't thinking deeply about risk. They thought deeply about who they work with on a transactional level and on a personal level. So it was a bit of a club, and no animosity towards them. I've worked with them. I like them. I've enjoyed working with them, and they've been a successful lender in the VC space. Have they become a successful large bank? No. Were their practices flawed? Yes. Should they have thought better about their complex risk? Yes. And they were highly correlated with internal relationships, I think is the way to put it.
Yeah,
so they were
I'll take your explanation. I think you give them a little bit too much credit for intentions. I don't share the same experience that you did. I found them to be, and maybe it's just my prickliness against that sort of set of relationships there. But I think the issue is they were all about the brand and nobody knew how to run a bank. And I'm sorry that you might get a pass on that for a year or 2 years. But at the point where you're a $200 billion bank and you're still making mistakes that were made in the 1300s from a banking operation when there were no alternatives to making the same mistakes that they made, I think that there's a deeper explanation as to what's going on there. And I think it's going to take us a while to figure out. I have said I continue to believe that there are elements of this business that do have value and will be sold eventually.
Oh no, the franchise is valuable.
Yeah, and I see that there are private equity and other folks sniffing around to try to buy the loan portfolio because they're viewing that as a cheap way to get a venture capital portfolio of their own, one that's been vetted to one degree or another. So I think this thing is going to get resolved over a period of time. But I think, and I talk to a lot of venture capitalists all day, every day. And there are people who are really worried about what's going to be the access to capital and what that's going to do to innovation and what that's going to do to our competitive edge as they see it in venture capital. I'm not quite so worried about that because I think good ideas find daylight. But
so you're talking on a national level.
Yeah.
No, I agree with you. And my screed the other day about this. I honestly think that that's where it's going. Is the government's going to be choosing the winners in the next cycle. I don't think we have a way around that.
We're going to come back and talk about that in a minute because I think that's a really good observation. Is that our government seems to be moving in lockstep into exercising the same sort of state capitalism that we chastise the Chinese for. So we'll come back to that. So anything else from anybody else about Silicon Valley Bank? So a week ago, things looked like we were pretty much on a glide path. The Fed was going to raise 50 basis points on the 22nd. We knew inflation was still a bugaboo. Nobody was really too worried. Those people who had exposure to crypto had sort of sequestered that, and it wasn't going to really happen. And now, less than a week later, what have we got going on? We've got more federal largesse. And let's set the background for this to an extent. The Federal Reserve was late to the game in terms of inflation. They called it transitory when I think they knew it was not going to be. They've raised rates to try to catch up in a record sort of fashion. They're still, to some degree, in the process of running assets off their balance sheet, which they bought during the pandemic. But at the same time, they're trying to take capital out of the system. And what do they end up having to do in this instance? We've now got open obligations at the FDIC and at the Fed to basically backstop everybody in the banking business. So I think most people within the sound of my voice understand how the FDIC works. You're insured up to $250,000, unless you're the governor of California or a Democrat donor at Silicon Valley Bank. And what the Fed has now done in an attempt to try to put an end to this sort of bank panic is they basically have underwritten or insured every deposit in the country. And then they turn around and they say, well, it's not going to be taxpayer money. The FDIC is going to increase its premiums to member banks, and the banks are going to pay for this. Well, I didn't look up, maybe somebody knows this. I didn't look up what the aggregate amount of bank deposits are in the country. Not that they're all going to fail, but if you're trying to tell me that this is going to be something that survives beyond this, and I think it is, there's no way that system works. We're going to end up paying for it at some point down the line. Let's hold that thought. And then to address this other issue of banks putting stuff on their balance sheet that they have to then mark to market, we've now opened up a not yet limited, so in other words, there's no cap on this, new facility at the Fed called the Bank Term Loan Facility, where banks who need liquidity to meet deposits and other aspects can pledge their assets, and they may be trading at 30 cents or 40 cents or 50 cents on the dollar, but the Fed will value them at par, 100 cents on the dollar, and lend them money for a year in order to get through the liquidity crisis. We don't know how much money that's going to be.
It sounds kind of like a federal takeover of the bank. They're going to get them for pennies on the dollar.
Well, we'll see. I mean, some of us lived through the RTC, the savings and loan industry, disappearing into a federally mandated department. And here again, this is sort of counterproductive to what the Fed's trying to do, because in effect, it's printing money to inject liquidity into the banking system, which is exactly the opposite of why they've been raising interest rates for the last 12 months to try to fight inflation. And in this instance, they won't tell you that it won't be taxpayer money, because the Treasury has backed the Fed up with a $25 billion backstop. And last I looked, the Treasury is us.
Yeah, they're a bunch of nutshells moving on the table in this one. It's kind of like
literally, this is a shell game. Yeah,
it's a shell game. The Swiss popped up about an hour ago and said, well, we're going to come up with $50 billion to back Credit Suisse, right?
Yeah, right.
It's going to be the same nutshell game, which is everybody in the cantons is going to go walk down the block to their representative and say, I didn't agree for you to give $50 billion to those guys.
That's real money. That's Swiss francs.
No, but exactly. So no, and they're pissed off because for the last 20 years they've been paying more than we do for pretty much everything. So there's this interesting kind of mark to market, come to Jesus back to back going on everywhere on everyone's assets who took part in this globalization exercise. And I think that's kind of what we're seeing. Yeah, not pretty. It ain't pretty.
So we've got a Federal Reserve that is driving with 1 foot on the accelerator and 1 foot firmly on the brakes simultaneously. And so schizophrenia is one of the things that is probably useful to be the chairman of the Federal Reserve. And I think this plays in well. Now, I'm gonna drop a little fact here, and again, you guys can comment on this. Do we have the ability to borrow on an unlimited basis? Mike, this is a question I know you know the answer to. Do we have the basis to borrow on an unlimited basis at this point as a nation? Or are we staring down the barrel of a debt ceiling?
B.
Yeah. Yeah. So we've got this open line of credit to the banking system, just to add to our open line of credit to Ukraine, and maybe our open line of credit to Taiwan, and maybe our open line of credit to save Medicare and Medicaid and Social Security and all our other unfunded liabilities as a government. And it's kind of hard to throw rocks at the people at Silicon Valley Bank or Signature Bank or anybody else if in fact the largest Ponzi scheme that we run in this country tends to be the funding of the federal government, which I would offer is on an unsustainable basis.
I do have a question, I guess.
Yeah.
One, you mentioned, yes, the curve of interest rates has climbed hugely. The 25 basis versus 50 basis, whatever, in the last year. But I think it also is fair to say that we've had 15 years of really not doing a hell of a lot towards inflation, right? So, I mean, you can't really just, I don't want to just blame Biden on that particular thing. The Fed did X. We've had, borrowing money at 0% practically for the longest time. And, old people said that's not good business. And then, newer people said, oh, let's do this as long as we can and get away with it. So I'd like you to take a shot at that.
Well, I got two numbers that I think that will give you my view on this in a very simple sort of format. The Joe Biden's fiscal year 24 budget is out. I think it's dead on arrival. But there's two things that are probably immutable in that budget that I think demonstrate this. The amount budgeted for the Defense Department in the fiscal 24 budget is about $880 billion. The amount budgeted for interest on the federal debt in that budget is about $830 billion. 2 years ago, that number was under $200 billion. So that's the curve you're on. And when interest on the debt starts competing with, Social Security and Medicare payments, stuff gets real. Stuff gets real in a hurry. And if we throw in a debt default in June, that number on the interest side explodes beyond what it's already done.
I guess my other question, do you know of any example, I guess, because you had your, I want to say SDLC or savings and loans banks. I mean,
Yeah.
some of these things have happened earlier, than this particular iteration, that one have not included some kind of federal bailout. I mean, when was the last time, something of substance, imploded, in the banking world specifically, I guess, where, the federal government didn't necessarily turn the bank, but said, hey, that's tough shit. That's the risk of doing business. And if we were consistent in using that kind of policy, and saying, hey, you're not too big to fail. It's on you. Would that sort of tempered all this and nipped it in the bud some time ago?
Yeah, there's a lot of questions embedded in that, Mike. Let me say it this way, okay? A lot of this started with Lyndon Johnson, guns and butter, Vietnam war on poverty simultaneously, okay? That yielded the inflationary spike, that plus what happened in 73 with oil prices, the geopolitical aspect of it. That whole process from mid 60s through late 70s is what generated the inflation that Paul Volcker had to come in and kill. And that's a situation where, which led to the savings and loan debacle. Okay, that was the first sort of massive bailout. Prior to that, there really wasn't a provision for us bailing out banks. Banks failed all the time. There were a number of large bank failures that have occurred, since 1903 when the Fed was created, or 1913 when the Fed was created, all the way through, present time. The problem that we've gotten into is that we never let the market correct the excesses that we've incurred, because we've always sort of been we've now turned to the Fed as the little Dutch boy who can always sort of put spackle or his thumb or some other aspect in the dam crack and kick the can down the road for the natural sort of creative destruction process that sits at the heart of capitalism. Okay? And if you aren't willing to embrace that there's a cost for failure, then you get these things where everybody's got sort of equal outcomes and nobody really meant to do anything bad, and we ought to bail them out, or it's going to be systemic and we need to bail them out. There wasn't anything like this in the Great Depression, and I'm not an advocate for going back to the Great Depression, but there was nothing like this that went on in that instance. And all we've done is sort of make the shell game bigger and
Yes.
kick the can down the road. And
It just seems to me that had we taken up that sort of discipline, had the discipline to let that market balance, we wouldn't be in this conundrum that we're in. It seems to me that banking itself is a very risky business, and one that actually takes discipline to be successful, because the margins are tiny, and you've got to string these things along year after year after year before you start making any kind of mass. And we've gotten so far away from that. That's why we're where we're at. This administration is probably the last one that's going to kind of buck, this trend. But are we going to be, is there going to be another administration that kind of gets back to the reality of this sort of thing? Because I also look at kind of the scale of how many occurrences this could be. It could be magnitudes of thousands, right? It could be a whole hell of a lot. At some point, the federal government's going to say, "No, man, I quit. I can't handle that volume. I can't do it. We can't get there from here," right? I mean, if it's onesie twosie, maybe that's one thing. Not that these numbers are small. So when you start getting that kind of volume, there has to be some kind of self-regulation that kicks in that makes, the government irrelevant in this discussion. We don't need you. Government's not big enough to be able to.
Can I opine, Stan, on this?
1 second. I want to make one comment. Government thinks it's big enough to do this, and I'll give you as the evidence of that. I'll give you as evidence. Right? No, I'll give you as evidence of that the Troubled Asset Relief Program from the Great Financial Crisis. We printed
designed
billions.
by two Goldman guys.
Yeah, and who was there trying to save SVB at the end? Goldman guys, right? So here's Mike. I think we're past that point where people don't think. Our whole financial system now has become based on not solid principles, but the notion that investment bankers and the Treasury Department can figure out a Rube Goldberg solution to anything. And I would offer as evidence of that, one, this stuff that we're seeing now. This is small scale. Two, what we saw in the Great Financial Crisis. Three, what we're seeing as it relates to the Treasury literally running the shell game on what's getting paid and what's not getting paid so that we don't breach the debt ceiling at this point. And right now it's small potatoes, but by June it's going to be worse. And if we have to print a couple more $100 billion to take care of this, oh, and by the way, Ukraine at the same time and everything else that we're spending money on, we've shown no discipline at all to restrain spending. As a matter of fact, it's almost a political imperative that we don't do that because people get upset when we take money away from them, foreign and domestic. So there's a little guy behind the curtain, much like the Wizard of Oz, trying to keep the wheel spinning and this, that, and the other thing going on. And I don't know that there's a solution absent collapse to that conundrum. And I'll let Jim take it from there. He may see more daylight than I do.
No, shit. I'm deep in a pool of darkness here, man. So Mike, you've been at the pointy end of the spear. You've always gotten instructions to go do what you did. You did them admirably and successfully for decades. These folks are playing with a rule book that they know they're in decline, right? So they haven't understood that they're irrelevant yet, but they're getting an immense amount of pushback from half the globe on things that they assumed were written in scripture, right? So when
thou shalt use SWIFT.
Yeah,
Thou
so
shalt use the U.S. dollar.
So when Blinken goes into a room, they're all sitting there in their dish dashes, with sipping their rose water tea with their hands crossed over their laps, and they're like, "Hello, how are you? Welcome, welcome, welcome. Talk to us." And he goes into this 10 years ago pitch. They don't understand that they sacrifice that. They're not pitching from a position of power anymore. And the sad part about this is it's going to push it back to the people you trained to go back and have to assert one more time in places like Ukraine, Moldova, as what does Stan call them? The Baltic dwarfs.
Yeah.
I mean, we're going to get sucked back into this, and all of the young folks that you trained in your career are going to have to go back and fix it because they're still 10 years, 20 years back on this. Well, we're still the most dominant force in politics, culture, money, and you have to sell the United States. You have to sell our ideas. And they haven't been selling. They've been asserting. And shame on us for not training them properly. What Blinken and his cohort doesn't sell the United States.
They demand compliance.
It's a demand on this moral and ethical milieu that they've mixed up with non-binary countercultural stuff that confuses our potential allies and our existing allies. Hence Hungary, hence Poland, hence Georgia, hence anybody we negotiate with. They got to be sitting in the room shaking their heads going, but we like you guys and you've been good for 20 years. You financed every well we've drilled in Punjab or whatever it is.
I would suggest less selling, more leadership. And what I mean by that,
absolutely,
if the United States of America just led by example, everyone would flock to us and say, "I want to be just like them."
See, but if
they got their shit together,
if they were recruiting you to be the civilian guy on the ground in province X in Nigeria to represent the program, you could place $100 million comfortably, and I'd be comfortable as a citizen.
Guys,
you would make the right choices, right? They've disintermediated the skill sets of critical engagement, and the Pentagon has been the biased point of the spear for a long time. Okay, but it doesn't mean you cannot shift and do the social components. we've just become a single tool family, right? We're really good with the hammer. And it's nice to watch these guys respond to the drone off Sebastopol, which is okay, we're running a drone. Well, leave it alone. You guys shouldn't touch it. Well, you touched it, you broke it. We had to put it into the ocean. That's horrible. We have in DC, we have no response beyond that. It's Hans Blix on steroids, right? They don't know what to do next, which is, well, where do you escalate? How do you escalate? What does it mean? And the sad thing is they just don't take us seriously anymore because we burned it on all this quibbling about 100 different things. We have no core.
Guys, this started with NAFTA.
NAFTA.
It did. It started with NAFTA when we imposed all sorts of labor and OSHA and environmental standards on Mexico, and we've taken that template and we've gone out and pounded it down everybody else's throats. We've expanded it now. Now what we impose on people is recognition of gender identity and all these other things that are anathema to a large portion of the planet, because they don't want to play if they have to reorder their society on the same basis as ours. And so our response to it isn't to listen and sort of find a way to make it work. It's to be insistent that they do what we tell them.
Correction. They don't want to play with us. They found another sugar daddy to go to that doesn't impose all that crap.
That doesn't do any of that stuff.
Hell yeah.
He talks a little funny, but he does give out money pretty freely.
Money ain't for nothing.
Yeah. So there is the rise of another player who we have basically financed through buying all the stuff that they make, right? So it's a tough problem, and there doesn't. And Mike, I think the key to your point is there's no solution until you're willing to recognize that you've got a problem. Okay, first step in the addiction book, right? And we aren't willing to acknowledge that we have a problem. We're going to double down on and expand the list of things that we demand obeisance on for us to do business with you. And it's not going to work. In the meantime, we paint ourselves into a corner from a financial perspective because we really are the borrower who's putting it all out there on Red 11 right now from a financial.
And we're borrowing on future performance, and we're performing badly, right? So put it in context. You have national leaders around the world whose job is to support their national interest. If you say national interest in the United States, you become reviled.
You're a white supremacist. You're a white supremacist.
Do you mean white Christian nationalists?
Yeah, exactly.
Well, I didn't call you that, but you're a bank examiner, so I fear you. But I mean, this is the problem we have. We can't even speak our language about the competitive risk we suffer for fear of being vilified by our own people. And so it's really hard to compete internationally. We have to kind of grow some and get into this scuffle. And I'm not sure how you do it around Washington without winning in the next election. It's going to be painful.
Yeah.
Yeah.
Well, we'll see about that. All right.
We're a little bit off. Talk to the Duke.
We're a little bit off topic here. I don't want to. We could spend the rest of the time on this, but I'll try to bring it back to where we are. And I want to say this: I don't think that the doom and gloom that I've talked about, and that Jim has talked about, or that Mike has talked about, is something that's going to happen tomorrow. I'm not trying to ascribe that to this tempest in a teacup, which is what I think this is. But I think this is a warning sign. This is a canary in the coal mine that under the current path forward, things are starting to break. And we will exercise the last full measure of creativity, spackle, and what's that stuff? Flex Seal. Okay, we got all the Flex Seal. Okay, our boat is made out of a screen door, and we're slapping this.
That's a lot of damage.
That's a lot of damage. We're slapping as every bit of Flex Seal we have, and ordering more that we can't pay for. But we're slapping every bit of Flex Seal onto the financial system right now to try to keep that screen door boat hydroplaning out there on the lake. And that's kind of where we are. And I think we're going to be okay for a while. But I think the Fed is going to continue to sort of move forward, and we'll talk about that in a second. So we're going to segue. I think from a domestic perspective, we've got these things pretty well ring fenced for now. I think that there's going to be some deflationary aspects that come out of banks sort of tightening up their lending programs, which is what the Fed really wants. But I don't think they're done with interest rates. Even if they paused this time, the inflation report this week, which was mischaracterized in a good portion of the media, still shows aspects of core inflation growing at a pace that isn't on the scorecard for what we need to do. And I've said this before, you saw it in the earlier slide, the Fed I don't think is going to stop until they break the labor market. And you've heard me say this before, I think they're going to have to keep going until they break the labor market. And I think that's going to happen with some scale in the second half of this year. Whether that's because banks aren't going to lend as much as they used to because of they're concerned. The Fed continues to raise interest rates. People sort of get scared by this, and they draw in on their spending, which we've seen a little bit of today in the retail sales report. I think we've started a cycle that's going to be contractionary as it relates to the economy, and I think the Fed's not going to stop until they get to 4.5% or 5% unemployment, which is a big move from where we are now.
So this is fear driven.
Yeah. Look, I said earlier, I think everybody who lived through it's got 2008 PTSD. I saw it all day today. Okay. And you're seeing it now as it relates to Credit Suisse, which is a good segue as we move on to the discussion on Credit Suisse, that a lot of this is response to what we all lived through with Lehman Brothers and Bear Stearns and Merrill Lynch and Goldman Sachs and everybody else who was on the verge. Wells Fargo, not Wells so much, but others that were on the brink of winking out of existence in 2008, 2009. So, Watcher, if you're not busy screening, can I ask you to pull up the slide on Credit Suisse, please?
I thought you wanted our first guest in, so we've got him in the back room when you're ready.
Oh, well, give us a topic, please.
Yeah. So the guest is one who's known to us, but his question today is, we'll let him ask it himself. Should we be paying off debt to increase liquidity, or should we be taking advantage of low interest rates we already have and not paying off debt early? And so we'll let Josh Ham get into that. Welcome, Josh.
Hey, Josh. I want you to know you are caller 001. You're the inaugural caller in this. So you have a responsibility to acquit yourself with honor.
I will do my best. So I've been seeing the writing on the wall as far as inflation was coming for a while. So years ago, I refinanced my vehicles. Just recently, I bought some land while interest rates were low and everything. But I'm a conservative-ish. And so I really want to be debt-free. I want to increase my liquidity by having as little debt as possible, because that increases my options if there are problems down the road. But the question is, should I increase my liquidity by paying off debts that I have that's already locked in with a low interest rate, 3%, 5%, low interest rates? Or should I be looking at acquiring assets? Like I got rabbits back here and chickens, and we're getting lumber materials and stuff like that. But every time I'm buying stuff to build, I'm not paying off debt. So where should I be prioritizing?
First of all, we're not offering investment advice here. We're going to speak to your comments or questions, but for regulatory and other reasons, I must say that this is not investment or financial advice. I'm assuming that your debt is amortizing. It's being paid down over that term, whether it's 3 years or 5 years or 10 years. Look, I'm going to answer your question by drawing a parallel to the activities of the federal government. Okay.
Mhm.
Now, during this period of time when interest rates were extremely low, okay, I mean, in some cases, negative real interest rates. We never went to negative interest rates in the United States. The Europeans did during COVID. We never did, but effectively rates were zero. 10-year treasuries, 30-year treasuries, 100 basis points, 125 basis points. And some of us have always asked the question of the Treasury Department, and I'll even go one step further. When there was a positive return on U.S. Treasury securities, and German 10 years were negative 50 basis points. In other words, you got less money back than you put in it, but there was some safety that you would get it back. I've never understood, and there's a group of us who ask this question constantly during this period of time and in prior periods of low interest rates, is why doesn't the federal government take the opportunity to do that, to go out and issue very long-term paper, to do what you did, which is I'm going to lock in fixed interest rates for as long as I possibly can, because then I know what the cost of my interest is 2 years, 5 years, 10 years from now. And you wouldn't get, our government finances most of our debt inside the 5-year mark of the curve. And so that's how we get to interest 2 years ago, 3 years ago was $200 billion. And next year it's going to be, let's call it $1 billion when it's all said and done. Okay. Because we don't know where rates are going to go between now and October 1st, which is the fiscal year of 2024. So if our federal government were to go out and do that, then it would have the opportunity to take $600 billion, let's just be simplistic about it, that it's going to spend on interest next year and do other things that add value. So I don't think you need to, some people double payments up to pay off their debt faster than this. If you're locked in for a sufficient period of time, take that cash and do other things that Joe can talk about,
Mhm.
that hardens your preparedness or your sustainability in your life, in your family, both financially and otherwise. I think that's not a crazy thing to do. Buy Joe's books.
Buy Joe's books.
All right.
I already bought them all.
I don't want to
Invest in
monopolize
quality steel.
I don't want to monopolize this. I mean, anybody else on the panel got a viewpoint on this? I mean, it's a good question. But look, to go to your point, one of the other examples is people with 3% mortgages. They ain't moving.
Yeah, stay on that. Yeah,
stay on. And so, I think you're headed in the right direction.
Appreciate it, gentlemen.
I'm going to buy
Appreciate
sheep.
you.
I'm not buying rabbits. I'm buying sheep. But that's a whole different conversation.
All right.
Different time.
I'm starting small.
All right. Thanks, Josh. We'll look forward to having you again.
Thank you.
Be good.
Anybody else?
We have another one who just entered screening, so I'll let you know once they're
hold
finished.
on.
just
I have
gonna
to
say that was
address
kinda
Rick's comment. I have to address Rick's comment. Really, bro? All right, moving on.
Are you getting trolled on 5?
On volume 5, yeah.
Yeah, I understand that. All right.
We call that the Sibley syndrome, right?
Yeah. I know.
Yes, that's the guy who's writing number 7, right? I mean, he's laughing you.
Joe, do you own small dogs?
I'm sorry?
No.
Do you own a small dog like Sibley?
No,
Yeah,
come
like
on, don't
those-
do that. Don't do
You get
that.
those little like bait dogs?
Okay, hold on. There is a small dog that resides here. I do not claim that one. Mine are the 2 large dogs.
Is it on your lap?
No.
Well, yeah.
Should it be?
All right. So those of us, and Jim is part of this mix. Those of us who have had the pleasure of doing business internationally, Credit Suisse is an institution known to us, has been for a long period of time. In older days, sort of happily known to us. But in recent years, since the gentleman in the picture there, TGNTM, came in, this bank has been on a one-way ticket to trouble. They have wasted the franchise to a great degree to try to make it into something it's not. I want to cut through this because I want time for calls, and I don't think that we have to worry about contagion in the United States from Credit Suisse. It is a big bank. It is globally significant and designated so by top central banks around the world. What that means is they're not going to let it fail. They can't let it fail. Now, Nouriel Roubini, if you know who Nouriel Roubini is.
Hey, Stan, when you say they, in this case, who is they? They
Swiss government, who bailed out UBS in 2008. Swiss, other European central banks like the Bank of England, probably the Fed. The Fed typically opens lines of credit to other central banks to be the backstop on all this sort of thing. There's not going to be a failure, I don't think, of Credit Suisse. I think it may reemerge as something different. But I don't think they're going to let this thing fail because the impact of this from a global perspective is I think just too severe, because just based on size and interconnectivity with counterparties. And one measure of the concern about this is this graph that you see here, which is the price for some arcane instrument that's called a CDS, or credit default swap. It is basically insurance against Credit Suisse defaulting on its obligations, trade or otherwise, to counterparty banks in the system. Well, you can see that spike on the right-hand side of the ledger. That started in 2021, has proceeded upward in 2022. And this is a little bit old because it added another 1,000 basis points to those credit default swaps today. That was the measure of the panic around, is this thing going to go tits up, to borrow a phrase? And that is, I think, a reflection of 2008 PTSD. Because if you step back and you look at it, I think it was really kicked off by the chairman of the National Bank of Saudi Arabia, who's the largest shareholder, saying, we're not putting any more money in. But you had to listen more closely to why he said they weren't going to put more money in. And that's because that would make the National Bank of Saudi Arabia then greater than a 9.9% shareholder, which made them subject to Swiss regulation. They don't want any part of that in this instance. So there was this dance this afternoon. The Swiss National Bank, which is their central bank, came out finally and said, yes, we're going to support Credit Suisse. Jim, you said you heard a number. Was it 50 billion Swiss francs later in the day?
Yeah.
Okay.
That was kind of, they're going to throw 50 billion at it. My guess is it'll escalate tomorrow.
Yeah. Well, the market will test that tomorrow. And it's going to test that on a day where the European Central Bank has to make a decision on interest rates. They had committed to do 50 basis points tomorrow at the last meeting. I don't see that happening until this sort of dies down, because this bank can really hurt a lot of people.
Any central bank that's moving now is moving politically or as a zombie on historical data. We need them to be nimble and very creative.
Well, yes, sometimes their creativity reaches back to bite us, but this is the issue with this bank is that nobody seems to have an answer as to how to undo what Mr. Thiam did. And it wasn't just him; it was the guys who succeeded him. But he sort of set the course, and it was all about a pivot to Asia, and they dismantled the private bank in North America, which nobody to this day can figure out why they did that. And it's been a mess for a long period of time, but it's a big mess, and it's their mess. So this is going to have an impact as it relates to sentiment. But I'll point out to you that from a U.S. perspective, I don't think it's going to be that impactful. And as evidence of that, I will give you that towards the end of the day today, something that everybody was watching, which is regional banks in the United States, they turned around and are showing signs of at least recovering some of what they've given up in the last 36 hours. And I think that's a sign that the creativity that the Fed and the Treasury have manufactured yet again in the short term is being met by the marketplace with acceptance, that they think that they're going to get their arms around this. Now, if we come out tomorrow and J.P. Morgan or Goldman or one of the big five banks is in trouble, we got a whole different deal. But those banks, I think, have been painted into a corner in terms of their capital requirements and their capital that they have on the balance sheet. I don't think that's likely to happen. I saw a number that Bank of America took in $15 billion in new deposits yesterday. That's a big number. So I think Credit Suisse is interesting if you have skin in the game as it relates to Credit Suisse. It's fascinating to watch. You can sort of this is where I get to harumph at this point. But I don't think it's going to be systemic from a U.S. perspective, and I don't think it's going to have any impact on what the Fed does tomorrow, this next week, and that's what I think we all care about.
So do you think the large banks have like the obsidian knife of sacrifice out? Are they harvesting what they can from this event?
I think what the 2008 crisis taught us, and what I think to the degree this is teaching us, is that when one of these guys is down, they're going to kick the shit out of him to try to make a buck.
Yeah, it's so tragic. Yeah, Yale.
So, all right. Anybody else, watcher, that we've got?
Yeah, we got one in the tube. Hold on, let me give him the link, and we'll see how long it takes to get in here. Shouldn't be about a moment. If you guys want to try and move on, and then we can.
Who do we have?
This is going to be Peter. I'm not sure if it's the fabled Peter Provenzano who gives us so many super chats, but Peter.
Very good. By the way, this is apropos of nothing, except I was thinking about Joe's internet and the issues he's had with T-Mobile. But Ryan Reynolds cashed out big time today, boys and girls.
Mint made big.
That guy, that is the second mega exit that guy has done, the first being Aviation Gin. And I'm going to be looking for him to buy a bigger soccer team than that third division team he and somebody else own over in the UK.
Yeah, no, he needs a distillery in Montana.
No, thank you. No, thank you. So are we?
He's on his way.
Okay.
That would just tell you something about these Hollywood guys. They're just there to make money. Right?
Yeah, but some of them are really good at doing that.
He's, I think, been the best of anybody that I've seen. I mean, because he's not done it just on the basis of movie or song royalties or anything else. I mean, he's been a real private equity guy, and he's pretty damn disciplined about it. I respect what he's done. You have to. I mean, this is an order of magnitude bigger than Aviation Gin. So,
yeah, he actually stepped into an executive role. It's interesting. Hey, Peter.
It is Peter.
Hey, it is Peter Provenzano, the provider of so many excellent super chats on both of our channels. Welcome, Peter. Thanks for being here. Uh-oh. Well, I swear when I screened him before, everything was working.
He has his microphone off. That's all it is.
There he goes.
Hey, Peter. Turn your mic on.
Can you hear me?
We can. Hello.
All right. Yeah. So the question is,
So when the interest rate gets so high that the legislature has to make real decisions, right? Do we default on the debt? Do we make the payments? Do we cut entitlements? Do we cut defense? What is the most likely course of action from the past performance of our politicians here, and how does that affect the nation, the world, and individual American citizens?
I'm going to let somebody else take the first crack at this because I don't want to monopolize the conversation, but I'll give you my comments after we hear from the panel. Anybody?
Well, no, Peter, it's excellent questions, and we're not here to give financial advice, but it's plan accordingly, and we're in a volatile time. So read your elected officials and your positions of your government and the markets, and look at it from your perspective. I don't know your perspective and I don't know your position, but be cautious and plan accordingly. It is volatile, and on a historical scale, it's very volatile. So plan accordingly and take care of your family. That would be my base assumption.
Anybody else?
No, I'd agree with that. I would say that in this time of risk, it's really a good time to have, as I said earlier today, a little bit of cash at home in the event everything shuts off. Because when it happened on Friday, it happened with literally no notice and no warning to those customers, and you don't want to be stuck at a bank like that. I would also say diversify, right? Put your liquid assets in more than one place in case one place has a problem and the other one does not. So,
yeah, I'm going to give you two aspects of this, neither one of which is going to make you very happy, I don't think, but it is what I think is likely to happen, and has been happening again since the mid 60s. And that is every time, and this is particularly true now when our debt is 1.4 roughly times annual. I'm sorry, 3 times what annual GDP. Let me do the math real quick. 1.4 times annual GDP, which is sort of a warning sign. We, being the American people, or those who are acting as governance on our behalf, have played the game of monetizing our debt by allowing inflation. The problem is that we've not really done a good job of getting to 2%. The nirvana from their perspective is 2% annual inflation, because that's a level at which the economy is sustainable, but also over the long term allows us to repay the borrowings from the 60s, 70s, and 80s with cheaper dollars in the future. That's the plan. That's been the plan since we went off the gold standard. Nixon took us off the gold standard. And so that's really what they're trying to get to, with a lot of volatility in the interim, like the current situation that we're in. But if you gave them a magic wand and said, what would you like in perpetuity? Inflation would run at about 2.5 or 3%, which over the long term would allow us to pay this debt off, all things being equal, and nothing else went wrong. The problem is all sorts of stuff goes wrong. And if it goes really wrong, you end up with any of the examples of hyperinflation that we could scare the bejesus out of you, starting with Weimar Germany and ending with Zimbabwe. And I'm concerned that I have a $10 billion Zimbabwe note around here somewhere that was given to me, and I just think that I think that if the current party in power has its way, with its need to commit to solving everybody else's ills as a way to continue to be supported, I think we're going to continue to create new mandates for us to spend money on, and we're going to devalue the dollar even more as we go forward, until we're not able to keep up with the level of inflation that we've created. That's my concern. That's my worry. I hope I'm wrong. History doesn't quite point it out, but I hope I'm wrong.
Hey, Stan.
Yeah.
I mean, that's kind of the way I understood the question. You answered it just exactly kind of what I was thinking, but a hell of a lot better than I could articulate. I think you're I'll use the term spot on that, and I concur.
All right, Peter. I hope we answered your question for you. We've got another caller in the line behind you, and
Buy gold. I love gold.
Thank you
That's
so
not
much for your
investment
time.
advice.
We appreciate you. We've got Bob coming on next. He's not quite in here, but he'll be in just a second.
Well, while we're waiting, listen, guys, don't spam our chat with homophobic comments. We don't need a strike. Please stop.
Hey, Bob Johnson, welcome.
On, guys. Can you hear me good?
Hear you just fine, Bob. Welcome. Glad to have you here.
No
Bob
problem.
Johnson makes
Thanks
really
for
good
having me.
hot sauce, just so you know.
Awesome. Glad you enjoyed it. Man. Already working on the next batch. They're already sprouted. So my question is basically.
Wait. Before you go, with that sort of lead in, what pepper is the base for your hot sauce?
Okay, it's actually a dual pepper base, and I use yellow Scotch bonnet and habanero, and then I ferment the peppers.
Oh man.
Yeah.
Oh, it's good.
Okay, we're gonna have to bring him back.
Yeah.
Yeah, and it's kind of cool because everything is homemade. So it's like I grew the garlic, the onion, all that stuff. So
Outstanding. That's tremendous. All right.
Cool.
What can we try to help you figure out here?
My question basically is, what if any exposure is there to the large like investment banks and firms like Vanguard, where the majority of the normal people's money is like locked up in 401ks and things?
Yeah, they tend to not be exposed to the commercial banks to this extent. Cash in those places. I mean, you've got market risk. By that, I mean market risk in terms of the value of either publicly traded securities or debt or what have you. Those folks tend to manage that pretty well. And so when those institutions were exposed was back in 2008, when money market funds were at risk of something called breaking the dollar. Okay. So the risk there is that their assets, treasury bill notes and other short-term paper, a lot of short-term acceptances, which are issued by municipalities in anticipation of tax receipts and other things like that. If that starts to break down, then those assets aren't worth the $1 per share of the money market fund. That's catastrophic, but we're nowhere near that. And I think enough has been learned since the great financial crisis, when at one point that was an issue, that I don't think that's likely to be an issue in this instance. So you've got market risk in your 401k. You've got market risk if you're indexing with Vanguard or you're doing whatever you're doing. You've got tangible market risk. I'm not saying that there's no risk, but I don't think you've got exposure you don't have the exposure that venture capitalists did with respect to companies that they've invested in losing their deposits at Silicon Valley Bank and being broke because of it. I don't think you've got that exposure.
Okay. Yeah, because the that was the one thing, especially the money market and short term, because I actually lucked out and saw the writing on the wall and moved a majority of my 401k into the money market right before Thanksgiving. Whenever
that's worked out really well for you.
Yeah, 40% so far from what I had to. So awesome. I appreciate your answer and your time.
Well, good luck with the sauce. If you've
Awesome,
if you've got Joe's address, you can send a sample to him and he will get it to the rest of us. How about that?
I don't think he's sharing.
Well,
I don't think he's
I was
sharing.
gonna say, I think it has to come to me if you want to.
You'll have to send one extra sample because there will be taxation.
While we have you here, I mean, have you got a website or some other sort of means where people can actually buy your hot sauce? Or
No, that's just a thing I do at home. But it is kind of
hobby.
interesting. I did just start a YouTube channel, so I've been kind of messing around with that and just.
All right, give us the shill. What's it called?
It's Guerrilla Shop Stew, basically a conservative union slant where basically we do exist and it is possible to kind of have both values, and that's kind of how I'm going to view everything through, is like that blue collar, lens. And that is the Guerrilla Shop Stew on YouTube, so I appreciate it.
Good luck with that. and people should check it out. And good luck, and keep us posted on the progress in terms of your hot sauce. And if you decide to make it a business, let us know.
And
Awesome.
keep it
Will do.
spicy. Keep it spicy, man.
Yeah,
We,
will do, guys.
We have a website you can sell through, if nothing else. We'll talk to you soon,
Yeah,
buddy.
you had me at habanero.
Yeah.
I'm trying some different peppers this year too. Like I'm doing the normal, regular Scotch bonnet and everything, but then I have a red habanero and some other stuff I'm trying. So
Nice.
Excellent.
All right, Bob.
guys.
You're making my mouth
Bye.
water. Get out of here. Get out of here.
Good luck
All
to you,
right,
Bob.
be good. Be good.
Be well. Thanks for calling in. All right, we're at about the hour and a half point here, which is where I tend to look to try to wrap things up. But I'm curious, do we have more folks in the queue? Because I'm happy to take calls for as long as we've got interest in terms of calls.
No, I didn't have anybody else, and I actually thought that we were going to be closing off, so I told everybody last call.
Okay,
And I
so
haven't had any takers after that.
We're exercising the Rush Limbaugh less is more model, which is fine. But I'm glad that working with like kids and animals is sort of the rule that you don't do in show business, and I'm glad that this went very, very well, and we'll do it again. I thought that was great, and we'll sort of get things sorted out a bit more. But thank you to our call-in viewers, and we'll look forward to doing more of that as we move on.
And they seemed like solid folks,
Yeah, well, there's no chumps in our chat. I mean, come on.
No, selling, sharing life, and what do you do?
There's a couple people in the chat talking about investing in silver, which I've been doing on a big scale. I wanted to point out to everyone that the good people of Austria have a tactical wisdom silver coin with my shield on it right there that you can buy. It's a half ounce. It's not really tactical wisdom, but they have a knighthood series, and this one's on. I think this is adventure. Yeah, it fits with me. But
and if you have to kill any vampires, you're good to go.
Right on.
So, who's that guy? Robert Kiyosaki? Isn't he the guy that's always pounding the table?
Silverman. Yeah.
Silverman. Yeah, I'll defer to him. I know that the pitch for silver is one, it's in short supply. Two, it's also an industrial metal. Three, all I can tell you is, at an earlier point in my life, I had the opportunity to meet the Hunt brothers, the guys who tried to corner the silver market. This was after that, and they had invested in Russian oil production. So this is 1996. Okay. And the stories they told, and the chastised nature of, because everybody always wanted to ask them, hey, how about that silver thing? I get a little squirrely about silver. Silver's got, based on what they told me, I'm a little squeamish about silver. If I probably don't understand it. I probably don't understand the dynamics of it well enough, but, yes. So I'm sorry. There's somebody, PD says there's 33 pounds of silver in each Tomahawk missile. I don't doubt that, but,
yeah,
I don't know that that's a reason for me to buy it right now. So
If you put 12 ounces in a sock and you swing it, it works.
Well, the only reason why I have more silver than gold is that it's more spendable than gold, right?
More fungible.
Yeah, more fungible. And don't fall into the trap of thinking you have to buy American liberties. They're expensive compared to everything else.
There's too much numistic value. That's what I'm saying.
Yeah.
Yeah.
I stick with
Exactly.
Krugerrands because South Africa,
Yeah, that's working well. Yeah.
I had that conversation today. There was once a day when belts of those coins were handed out to people who went into harm's way. It's no longer the same, but a lot of those belts disappeared during operations. So.
Look, I think anything, and there's a comment that it's a hedge. I don't disagree with that. And so precious metals, and precious metals are something that is a hedge that you stick into your portfolio. Don't look at it daily, weekly, monthly, yearly. Just look at it over time, because that is it's meant to be the thing that keeps you from being eaten completely by inflation, but it's not on its own. It's not an investment strategy. That's That's my comment. That's not investment advice, but it's a view that I think makes some sense. So I don't begrudge anybody doing any of that stuff. I mean, flawless diamonds work most the same way as some of this stuff does, and they're portable, real portable.
But listen, if you're going to buy Britannias, only get the ones with Elizabeth on them. Once they put Charles on them, they're going to be worthless.
That will destroy any numismatic value. That's correct.
Yeah.
No question about that.
Who's a really unattractive guy on the coin?
It's what's his wife's name? I can't remember.
Bob.
Camilla. Yeah.
Camilla. Yeah, it's Camilla. It's not Charles at all.
No, that's their caramel.
Yeah. All right, Joe. Anything for the good in the Commonwealth?
Not really. Just that these are really tough times and really scary times. So I would the same thing I said earlier. Get a small amount of cash, whatever you can afford, and keep it at home. Even going all the way back to the power outage in Moore County, North Carolina, they weren't able to transact any business electronically. Having cash enabled some people to buy gas when everyone else couldn't. So having some cash on hand is probably your best hedge against bank failures. That doesn't mean all of it, but some.
James?
I mean, I'm in the world of just golly. I can't believe we have to have these conversations, but have cash on hand. Understand that you are a disposable asset of the state in our situation, which is sad. And when representatives of the state engage you, understand you're a disposable asset of the state. Because we've kind of gotten to that point, and it's not a repudiation of our government or our country. It's just a recognition that they're under an incredible amount of duress. So keep it in mind when you deal with them. That'd be my 2 cents.
Mike, thoughts? Progress on 7. Where are we now? What chapter are we on?
I won't talk in terms of chapters.
Okay.
That's kind of ugly. This one's taken just a lot of
well, this is the backstory. This is the origin story, so it's got to be.
And it's based on a lot of really factual things that happened. Blah blah blah. So there's just little details I want to make sure I get right.
Well, I understand that.
All that kind of crap.
Well, on the Sibley timeline, you got plenty of time. So.
Well, this is really funny because my not Latvian, damn it, Lithuanian connection was in there today, and I actually got some work done.
Back rub?
No. And when I say I got work done, I mean I wrote 4 paragraphs. But
it was a dark and stormy night.
Not a lot of work. They're damn good. They're damn good paragraphs. That's all I can say.
That's all.
But anyway, those folks were like, "When are you going to be done? When are you going to be done? When are you going to be finished?" I said, "Do you know Mark Sibley?"
Yeah. Ron, what's going on in the Black Hills?
Oh, not much. Another snowstorm coming tonight, and another one next week. Another couple feet of snow coming up.
Who have you guys pissed off? I mean, this has been
good. It's a good thing. We the last few winters were really empty of snow, and we had some really dry times in the summer here in the Black Hills. A lot of wildfire danger. Not a good thing when you're living amongst the trees.
Yeah, no, that's right.
A very green summer, and the farmers and the ranchers are looking forward because they use groundwater. They don't use a lot of irrigation or anything like that. They just use natural groundwater.
Mm-hmm.
Looking for some good times here in South Dakota, agriculture wise and forest wise.
So, Watcher, we've got I think a hot sauce identified for your future.
Yeah.
Just saying.
What's funny is it's not the first time I've incorporated hot sauces into one of my businesses, but
I understand that.
Yeah, I'm also excited because James put us in contact with a writer today And so you might get to see some very interesting new sorts of content coming out of Future Conflict. future-conflict.com.
Understood. Well, let me leave us with this. I as I said, I think we're going to be in for volatility. I think the rest of this year. I think the general trend I think the risk is predominantly to the downside as it relates to most things economic as we move forward in the rest of 2023. And I think that's largely a function of what the Fed likes to call long and various lag times. We're just now seeing the impact of prior interest rate raises. So keep your head on a swivel. You know, if you may not need that $72,000 Ford 250 pickup truck that you have to finance for 84 months and at 6 or 7%. And just be smart about stuff and keep your head about you at this particular point. I don't know if we're at the point where, like my grandmother did in the Depression, where you need to wash aluminum foil, but if you have to at some point as well. So it's a good time to be smart about your own survivability and your own sort of financial wherewithal and independence. Now, next week we will be back. I keep seeing requests for Little Bird stories from Ron. We'll be back on topic that may, in fact, yield some of those. We'll talk a little bit about that as we announce our schedule for the next 8 weeks. And that's part and parcel of our mantra that we're trying to look around the corner, although the corners keep shifting at great pace in today's world. Trying to look around the corner at things that will impact the news in the future. But there's plenty of those things to go around. Now, we've got, as an example of that, we've got Xi Jinping in Moscow next week, with a telephone call with Zelensky thereafter, which should be interesting. We've got increasing tensions in the Black Sea. I see that Senator Tom Cotton of Texas says we should marshal the U.S. Navy, stick them in the Black Sea, in which there's one way in and one way out, and fly more drones around Sevastopol, which to me is a perfect strategy if you were in the Army, which he was. And so I hope that we can keep our elected leaders, from getting us into a conflict that we don't have any business being in at this particular point. So, and God bless Ron DeSantis for saying that it's not an existential question for the United States to have to fund Ukraine. And one thing I'll mention, those of you who know my politics and who follow this channel and or CFC know my affinity for Chip Roy of Texas. Chip Roy is going to endorse Ron DeSantis for president in 2024.
Well, I'll tell you, the left is acting like Ron DeSantis said we should throw babies in the fire.
Yes, he did. Yes, they are doing that, and it took some guts because he knew that was going to be the take, and everybody with a Ukrainian flag in their profile now hates him. So,
man,
they would have anyway. So
they would have anyway.
What's good about this is it causes Lindsey Graham to double down, right?
Right. Oh, Ladybugs is losing his mind. Anyhow.
No, so it's this is going to be. You have to have comfort in the fact that there's going to be a free-for-all brawl around our next election. And as a voter, keep your sanity, meet your neighbors, try to get them to get online and get engaged and speak the truth. It's an important thing. So that's my take.
Yeah, Rick, Duke of Malta, if I were a Florida resident, I would feel the same way you do. But he may be facing a higher calling, my pal. And I know there's people who don't trust Ron DeSantis, and they're trying to find, where all the WEFers are doing whatever. But this will play out. Our election process takes too long. But one of the benefits of it is that if you've got something to hide, it's pretty hard to hide it with that level of scrutiny over that period of time.
Yeah. You mean like a laptop?
You mean like Obama?
I was just going to say, unless you've got the media running cover for you, in which case, the sky's the limit. The truth though is that Biden didn't really try to hide much. He just hid himself in the basement.
I was gonna say he
part of
just
the
bunkered.
strategy.
He just bunkered up. It's classic wartime strategy.
So I do see that it has been confirmed about a $3 million payment right after he left the VP office from a Chinese energy company for God knows what. So we may be getting into some territory where we
but it went through 3 holdcos, so you can't hold him personally responsible.
Yeah, right.
So so back to the important things. Stan, are we going to be posting pictures of you in yoga pants or no?
No, I don't own a pair of yoga pants. Sorry about that.
Ron, do you own yoga pants?
No.
Boy, that's a drag.
It's down to you, pal.
God.
Yeah, come on, dude.
Oh, dear Lord.
How about a
I
kilt?
mean, we never see your face. We just see little graphic representations of God knows what.
Snippets.
Day old sushi in yoga pants. That's an
Wow.
image.
You guys should be. I have seen his face, and
I'm going to make this happen. y'all are asking for hail.
So I don't no.
Don't call down the thunder if you can't stand the heat. Is that what you're saying there?
Exactly.
I like this one. Stan only has the Zardoz banana hammock. Now that's a reference. That's a reference.
Well,
a hell of a reference
I think I could rock that like Sean Connery did. Probably better than what Sean Connery did, to be honest, at that point in Sean's life.
Yeah, but you don't have the sexy accent, dude.
No, but it's the Bostroma swing.
Those of you who know, it is the Bostroma string.
It's a known thing.
It is.
All right, gents. I think that takes us out for the evening.
Yeah, please save us from ourselves.
All right.
That's
Thank you so much, chat.
Hey, good night. Good night, everybody. Thanks for joining us, and we'll be back to blowing up shit next week. But the idea today was to sort of focus in on the what is really going to be an important 2 weeks in financial markets. So stay tuned, and just know that Silicon Valley Bank and its depositors and board members and the VCs are all writing checks to Joe Biden for bailing them out this week.
Absolutely. Nationalization.
While he tours California, doing whatever he's doing, selling used submarines to the Australians. Show me the subfacts. And on that, we're out.